Tonight, I'm going to say something that sounds impossible, until you recognize the machine that produced it. A single overheating problem at a data center can silence the world's most important derivatives exchange for hours. That happened at CME Group in late November 2025, when a cooling issue at Cyrus One data centers halted trading across futures and options, metals included. And here's why that matters more than the headline. When the screen goes dark, the risk doesn't disappear. The positions don't disappear. The need to settle doesn't disappear. Only the illusion disappears. The illusion that markets are permanent, smooth, and always there to absorb stress on demand. So when you see clips and viral claims saying China rejected a U.S. emergency deal and COMEX is closed, I want you to pause. Some of what's circulating is unverified or exaggerated, but the structural pressures behind those claims are real, documented, and escalating. Tonight, we separate rumor from mechanism because the mechanism repeats. Here's the statistic that makes the whole picture snap into focus. By the third quarter of 2025, global debt climbed to nearly $346 trillion, about 310% of world GDP, according to the Institute of International Finance. That number is not trivia. It's the engine room. When the world is that indebted, the system has only two ways to stay upright: reduce claims or expand confidence. Reducing claims means defaults, layoffs, austerity, and political revolt. So the system expands confidence by expanding paper assets, paper collateral, paper settlement, paper liquidity. It turns promises into a substitute for reality. Retention check. Remember this. In a debt-saturated world, the real crisis is never price. The crisis is settlement, because price is a number. Settlement is a promise, and promises break in patterns. Here's the deal. If you understand one repeating four-stage machine, you'll understand why outages matter, why margin hikes matter, why export licensing matters, and why the phrase technical default keeps showing up in markets that supposedly can't fail. And in about 5 minutes, I'm going to show you the single question that instantly reveals whether you're looking at a normal market or a market that has quietly entered its reset phase. Now, the machine, 4 stages, every time. First, trust is engineered. A dominant power or market builds a believable unit of value and a venue where claims can trade. The promise is stability. The promise is, this paper is as good as the thing. Second, claims expand faster than settlement capacity. More credit than collateral, more contracts than inventory, more promises than reserves. It feels like prosperity, but it's a ratio problem hiding behind confidence. Third, conversion demand arrives. A shock hits, and people stop wanting exposure and start wanting possession. They start asking, can you deliver? This is where weak joints show up. Outages, margin spikes, capital controls, export licensing, temporary rule changes. Fourth, rules are rewritten to protect the system. Convertibility is limited. Delivery is delayed. Markets are paused. Margins are raised. Defaults are managed. The old system survives, but only by becoming something else. And whoever believed the original promise learns it was conditional. If that sounds abstract, good, because now we make it concrete. 3 case studies, 3 different eras, same output. Think of them as 3 independent lab tests. First test, Rome and the slow killing of silver money. The setup was genius. Rome needed a unit that could travel across provinces and still mean the same thing. The denarius wasn't just a coin, it was coordination. Pay soldiers reliably, collect taxes, price goods, run a complex empire with a shared language of value. Then expansion arrived. Military costs rose, border defense became permanent, politics demanded spending, and tax hikes carried risk. Rome found the oldest temptation in finance. Keep the face on the coin, reduce the silver inside it. Debasement became a hidden tax. It felt painless at first because the coin still looked like a coin. That's the trick of stage 2. The promise stays visually intact while the substance thins. Then crisis, conversion demand. People began testing reality. Older, higher silver coins were hoarded. Newer, weaker coins were spent quickly. The public didn't need a spreadsheet to notice that money was changing. Markets began pricing in distrust. Barter returned in places. Contracts became harder to write because the unit itself was unstable. And then the outcome, rule changes, not confession. When states lose confidence, they don't say, we broke the promise. They say, we are restoring order. In 301 AD, Emperor Diocletian issued a sweeping price edict, attempting to force stability through law. Coercion replaced confidence, but coercion can't conjure silver. Over time, the system reorganized. More in-kind taxes, more administrative control, and later a stronger high-trust coin in Constantine's solidus. The empire survived, but the original stable silver money for everyone promise was gone. Trust, overissuance, conversion demand, rule rewrite. Second test, Weimar Germany, printing, reparations, and the collapse of the mark. Setup, a society that still expected money to store value across time. People saved, people planned, money meant tomorrow still counts. Then expansion. After World War I, reparations and internal rebuilding created fiscal math Germany couldn't politically solve. Tax enough and you risk revolt. Cut enough and you risk chaos. So the state printed. It monetized the gap. It expanded claims on real goods without expanding real capacity to settle those claims. Then crisis, and notice how it arrives. Not as a single explosion, but as a change in behavior. People accelerate spending. Businesses reprice faster. Savers panic. And in 1923, after the French and Belgian occupation of the Ruhr, the government backed passive resistance, paying workers who weren't producing, financed through even more printing. Prices began changing daily, then hourly. This wasn't madness. It was conversion demand. The public was converting paper into anything that could hold value. Outcome? Stabilization through a new framework. The Rentenmark mark appears, reforms follow, discipline is reintroduced. The system survives by becoming something else, but the reset isn't neutral. It transfers wealth. Debtors benefit, savers get destroyed. That's stage 4 in human form. Third test, Bretton Woods and the day convertibility died. Setup, 1944. The world builds a new order. The dollar anchors global settlement, other currencies pegged to it, and official foreign holders can convert dollars into U.S. gold at $35 an ounce. The promise is explicit. That promise creates trust. That trust creates scale. Then expansion. The global economy needs dollar liquidity. The U.S. runs deficits and exports dollars. Dollars pile up abroad, and a ratio silently worsens. Dollar claims versus gold reserves. Economists called it the Triffin dilemma, but you don't need the textbook to understand it. If everyone has a claim on something and the claims grow faster than the thing, the system depends on most people not redeeming at the same time. Then crisis, conversion demand, foreign holders test the promise, gold outflows rise, attempts to manage the price appear, including the London gold pool. When that breaks in 1968, the system shifts to a two-tier market. That is the sound of stage 4 starting to whisper, a partial rule change to postpone the full rule change. Outcome? August 15th, 1971. Nixon closes the gold window. Convertibility ends. The promise is rewritten. The system survives by mutating into floating exchange rates and deeper financialization. Different centuries. Same machine. Now we run the machine on the present, and this is where you start feeling why it's urgent. Stage 1. Setup. Today. Global finance runs on paper claims and collateral chains. Derivatives are the nervous system for pricing risk across everything. In metals, COMEX is a major reference point for the price of gold and silver. Most participants trade exposure, not bars, but the psychological glue is this. Delivery is believed to be available if demanded. That belief is the bridge. And stage 2 is when the bridge gets crowded. Stage 2, expansion, today. When debt is this high, the system must keep funding conditions supportive just to roll the mountain. That means more leverage layered on leverage. It means more promises linked to the same underlying collateral. It means more paper exposure in markets where the physical underlying is not expanding at the same rate. This is the part people don't like hearing. Paper works beautifully until it works too well. Because when paper becomes the dominant way to express demand, the system can grow claims faster than the underlying settlement capacity. It's not always fraud. It's often convenience. It's efficiency. It's market innovation. But it still creates the same ratio problem. Now under the tool that reveals the truth, margin. Let me explain margin in the simplest way possible. Margin is not a fee. It is a survival test. It is the exchange saying, prove you can absorb this volatility or get out. When an exchange raises margin requirements, it's saying, you can stay only if you bring more cash right now. That is not neutral. It turns liquidity into selective survivability. It forces the weak hands out, not because they were wrong, but because they were under-collateralized. And again, we don't have to guess. CME clearing advisories show higher minimum performance bond requirements for COMEX silver products effective after January 30th, 2026, including higher percentages for different risk profiles. Verified. Now stage 3, crisis, today. This is where it stops being a chart story and becomes a settlement story. First, infrastructure fragility. CME's late November 2025 outage halted trading across major markets due to a cooling failure at data centers. If you were hedging, managing risk, or trying to adjust positions, the world's most important risk transfer machine just told you. Not right now. Undeniable. Second, collateral stress. Margin hikes can trigger forced liquidations. Forced liquidations amplify moves. Amplified moves trigger more margin hikes. In a feedback loop, the market starts reflecting forced behavior, not voluntary belief. That's when price becomes less like a signal and more like a distress alarm. Third, sovereign choke points. China's Ministry of Commerce published a list of companies permitted to export silver for 2026-2027, 44 companies, per Reuters reporting on the statement. That means export flow becomes permissioned, not automatic, not purely market-driven. Now let me show you what permissioned really means in human terms. It means a factory can have purchase orders, cash ready, and demand exploding, yet still face delays because the gate isn't just supply. The gate is approval, timing, and policy. In other words, the market isn't only asking what's the price, it's asking will the shipment be allowed to move? And that's why rumors about emergency deals spread so fast, because they're emotionally plausible in a system where access is gated. But here's the credibility upgrade. You don't need to believe a specific backroom story to understand the danger. The machine doesn't require a secret meeting. It only requires the conditions for secret meetings to become useful. So instead of repeating a rumor, here's the higher quality question. What happens when paper demand collides with a physical bottleneck that is gated by policy? Before we move on, I want to add one more retention layer, because this is where most viewers get lost. They hear margin hike and think boring. But margin hikes are one of the loudest alarm bells in modern finance. Picture this. You're a producer, a refiner, a jeweler, an industrial buyer using futures to hedge. You're not trying to win. You're trying to survive volatility. Then volatility spikes and margins jump. Suddenly, your hedge requires more cash. Today, right when your business is under stress. If you can't post it, you're forced to unwind. If enough hedgers unwind, the market becomes even more chaotic, and the exchange responds by raising margins again. That's the feedback loop that turns a market from a tool into a trap. This is why people describe a silent default. Not because the contract disappears, but because the terms for staying in the contract become unaffordable for more participants. Access to the market itself becomes restricted by collateral. That is, stage 3 behavior in a paper-heavy system. Now we close the open loop I promised earlier, the single question that reveals what kind of market you're in. Ask this. If everyone tried to convert their claim into the underlying at once, would the system encourage it, or would it change the rules? If the answer is, it would change the rules, you're not in a pure market. You're in a managed settlement system. And that's not an insult. That's reality. Here's a visual you won't forget. A ticket says, seat A12. Most nights, you sit down and forget the ticket is a promise. Then the venue is oversold. Suddenly the staff rewrites rules. VIPs first, refunds for everyone else. Come back tomorrow. The ticket didn't change. Reality did. The ratio got revealed. That's paper versus physical. Now stage 4, the outcome today. When claims exceed deliverables, the system survives by rewriting rules and rerouting settlement. Higher margins and lower leverage become semi-permanent. Position limits tighten. Delivery terms harden. Stability measures proliferate. More bilateral deals move outside the most stressed venues. The system doesn't collapse, it consolidates. And here's the part people underestimate. Consolidation feels boring while it's happening. It looks like new policies. It looks like risk controls. It looks like temporary measures. But it's a one-way door. Once the system learns it can protect itself by changing the rules, it keeps that option forever. Now, the classic objection, but this is modern. This is America. This is technology. This time is different. No. Rome had administration. It's still debased. Weimar had economists. It's still printed. Bretton Woods had treaties. Convertibility still ended. Technology doesn't erase the ratio. It speeds up the test. Now, quick myth busting, because retention dies when viewers feel confused. Myth 1. If a market is big, it can't break. Size doesn't prevent failure, it amplifies consequences. The CME outage proved that even the largest venues can go dark. Myth 2. Price discovery is automatic. Price discovery is a function of continuous trading, functioning infrastructure, and willing counterparties. Pause any one of those, and the price becomes a memory. Myth 3. Margin hikes are just normal risk management. Sometimes they are, but in extreme volatility, they also function like a gate, deciding who is allowed to stay in the game. Myth 4. Export licensing is a minor administrative detail. In critical materials, licensing is a lever. It doesn't need to ban exports to change the market. It only needs to control timing and eligibility. Myth 5. If a story isn't officially confirmed, nothing is happening. The opposite is often true. In stage 3, the public rarely gets clean confirmation until after the rules have already shifted. Hold those myths in your mind, because they're the excuses people use to stay asleep while the machine moves. Now make it personal. Even if you never trade futures, you live in a world priced by them: fuel, food, borrowing costs, business risk. And if you're younger, don't turn this into a dare. Don't take on debt to gamble on chaos. Talk to trusted adults before financial moves. The goal is understanding, not panic. So what do you do with this information, practically, without falling into doom, hype, or denial? 3 rules. Rule 1, think in stages, not headlines. Every headline is noise until you locate it in the machine. Setup, expansion, crisis, outcome. When you can name the stage, you can predict incentives. Rule 2, reduce fragility before you chase opportunity. In stage 3, leverage is not power. It's a hostage situation. A rule change or collateral demand can force you into the worst decision at the worst moment. Build buffers, keep options. Rule 3, watch access signals, not just price signals. In a reset, availability can matter more than, quote, watch premiums, delivery times, policy changes, and which counterparties are tightening terms. That's where the real story lives. Now, a question for you. Answer it in the comments because engagement matters, and I want to see how you're reading this. Which stage do you think we're in right now? Late expansion or early crisis? Because the receipts look like stage 3 pressure. Record global debt, a major exchange outage freezing price discovery, official CME margin changes, China formalizing a permitted exporter list for silver. Check. Verified. Undeniable. Final warning. The reset won't arrive with sirens. It arrives with memos, margin schedules, licensing lists, temporary suspensions, and quiet changes to what counts as acceptable collateral. By the time the public admits something structural changed, the advantage of calm preparation is gone. So do 2 things right now. Subscribe, because the next episode is how the machine was built. And once you see the construction, you stop falling for surface narratives. And watch the next video, because we're mapping what stage 4 looks like in real time, the signals that confirm it, and how to build resilience without panic. History doesn't repeat because people are stupid. It repeats because systems have constraints, and constraints produce patterns. See you in the next one.